I'm excited to share with you, and I think you'll be jumping up and down after you watch this video, the way that thousands of people, we help thousands of people all around the country every single year buy homes this way. It's going to open up your eyes to the possibilities that you probably never thought imaginable. I'm talking about buying a home with bad credit, no credit. Buying a home if you're self-employed. We've all been there and done that, where we've had bruised credit, banged up credit, and it's hard to buy anything, much less a home. But I'm going to share with you in less than 15 minutes the opportunity that you can take, the steps that you can make to purchase a home, to negotiate the contract, to find these properties, and get the best deal for you to become a homeowner in less than 15 minutes. Now, really quick, allow me to introduce myself. My name is Wayne Turner. For nearly 30 years, I've helped thousands of people buy and sell their homes. I've bought, flipped, built, done just about everything when it comes to real estate. So I'm excited to share with you the information that will help you through the process of anything when it comes to real estate. This information doesn't cost you anything. It's free to subscribe. You'll want to share this information, comment, ask questions, and be interactive as we follow through and walk through this video in less than 15 minutes. So let's jump in. So look, we've all been there, banged up, bruised credit, lost a job, divorce, death, injured on a job, whatever it may be. A couple of months go by, you get down, your credit gets backed up, next thing you know it's bruised, it's hard to finance anything, especially when it comes to buying a house. But I'm gonna show you, grab a pen and a piece of paper, the steps that you can take to buying a home without a bank or a mortgage company, most importantly, how to find these homes and how to negotiate the best offer for you. You have to understand that within 30 days of you watching this 15-minute video, you're going to be equipped with the tools necessary to go out and find a home, buy it without a bank, and close on it and move in. Now, when it comes to the details of buying a home this way, they call it owner's terms. And the term meaning that the length of term that you're going to finance it. You're not going through a bank or a mortgage company. The seller is basically financing the home. But they'll do that on 15, 20, 30 years, just like a traditional mortgage company. They also will charge you an interest rate, and you're also going to negotiate the price on that home between you and the seller. But look, before we move on, there's something critical that you must understand before buying a home this way, and that is it cannot be done with just a handshake. Buying a house this way is completely legal, and it needs to be done legally. That means an offer to purchase in writing is agreed upon. You can download contracts, you can find all that kind of stuff. You can go to easylandlordforms.com, for example. You can get contracts, you can find all this stuff, right? But it has to be done legally. It has to be recorded with an attorney, closed with an attorney, and recorded in your county tax assessor's office and deed. Listen, there's an old saying, if it's not in writing and it's not signed and it's not notarized, it didn't happen. But look, here's where it can get tricky. The seller can do what they call a balloon payment. You may have heard of that term, or a call. That means after 2 to 3 to 5 years, once again, everything's negotiable in the contract up front. They can say that you're going to pay me in full. In other words, I'm going to finance the property. You're going to live in it for 2 or 3 years, but after 2 to 3 to 5 years, whatever you negotiate between you, the buyer, and the seller is requesting all of their monies at that point in time into the future. But look, I tell you that so you can have the confidence knowing that you can buy a house that way within 2 to 3 years out, 3 years on a conventional, 2 years on an FHA, but that doesn't mean you can just kind of go buck wild and have your credit crashed and trashed. You need to maintain a 620 higher credit score, have proof of income, proof on your job, proof of tax returns. If you're self-employed, you got to watch writing so much stuff off. I get it. I know where you're coming from, because you write off tools, you write off absolutely everything, anything that you're doing, you write it off, right? So you can have a less tax basis. No one likes to pay taxes, me included, I get it. However, you have to make sure that your basis, your credit, and everything is up to par during that 2 to 3 year time frame. And after which, you can go to a traditional bank mortgage company, and it's almost like what they call a streamlined refinance. If somebody lived in their home and they already had financing on the house and they wanted to lower the rate, for example, that would be a streamlined refinance, because everything is in your name. The deed's in your name, the property is, you own it, and it's yours. So that way, when you go to a lender, it makes it super easy for you to transition from that seller's loan that they've been carrying to the mortgage company. Now look, I know what you're thinking. Don't panic, stay with me. Oftentimes people are like, Wayne, I can't finance it now. How am I going to finance it in the future? And I'm going to share with you how you can do that. You see, once you take ownership in the home, you own the home. It's your home. You got driver's license, you're paying taxes, you're paying insurance, you have utility bills in your name, and most importantly, you have the closing documents that you purchased the home between you, the buyer, and the seller. You've also been paying payments on this, right? So you can show all that to a mortgage company. You have to understand, you're doing the banks a favor by letting them loan you money. not only are you doing them a favor, but you now have equity in the property. So you bought the home for X number of dollars, you put money down on the home, you've got a balance that you've been paying down because you've been paying monthly payments, and then that property's going up in value. So now you have built-in equity. You've lived in the house for 2 to 3 years. Another thing that's really important that people have to understand, if you have filed bankruptcy, 2 years after your discharge date, you can actually get an FHA loan on a home. Now let's switch back real quick to the terms in the purchase. You see, when you close the house like this, you're going to use a closing attorney or a title company. It's going to cost you anywhere from $400 to $500. You're also going to look at a title policy. Now, title policy covers you on the house from the day you purchase it, from anything back. So if anything's been done, work, central heat and air, or anything like that on the property, they will double check for you to make sure there's no back taxes, liens, encumbrances, mechanical liens, or anything like that. That way, no one's gonna come knocking on your door and say, hey, you owe me $5,000. Be like, I just bought this house. Be like, well, the owner's supposed to pay me, somebody's gotta pay me. You're not gonna deal with all that crap. You get a title policy, and you'll wanna get a title policy. Some areas, counties, parishes, states, the seller pays, some the buyer pays. Depends on where you live. You'll just have to call a real estate attorney and ask them. You can Google, find a good one in your area, your town. Ask them if they got a blank contract that you can use whenever you find a house this way. But you'll want to make sure it's recorded. And you'll also want to ask this question. This is important. Will they service the transaction? In other words, they can be the servicer. They can start an escrow account for you. They can hold monies in escrow, because in addition to paying a principal and interest payment, now you don't have to pay private mortgage insurance. There's no mortgage company involved. However, you will have a principal balance plus the interest that you're agreeing to pay the seller, and then you'll also have taxes and insurance, because this property is going to be yours. You can paint it, cut the grass, do whatever. It's your home. Even though the seller's financing it, all they're doing is acting as the mortgage company. The cool thing about that is they don't do background checks, crazy detailed credit checks. Most of the time they don't even verify your income or your taxes. However, you do have to have some skin in the game, meaning a down payment. And once again, everything's negotiable, but what we're seeing for the most part is sellers are wanting a minimum of 10% down. That's not to say you have to have that. Some sellers are willing to take 6, 7, 8%. Some of them want as much as 10, and there's a few out there that won't do it for less than 15 or 20. Now, something else that you need to be made aware of is when you sign these documents, oftentimes there's a prepayment penalty. You just need to ask the seller, is there a prepayment penalty? Because oftentimes the seller will want to sell you the home this way, and they do not want the home to be paid off early. And the reason for that is because if they own the home outright and they're selling it to you, once you get a refinance, for example, and you pay them in full after 2 to 3 years, they're going to get all their money. Once they get all their money, that is an investment property, and the Internal Revenue Service, the IRS, says that that is a source of income. It's a means of income, and therefore you have to pay capital gains. So oftentimes a homeowner will sell you a property, they'll do owner's terms, they'll give you a pretty decent rate, but with that rate, they also don't want it paid off. So you have to ask that up front, and they'll do that to help justify their taxes by adding in what they call a prepayment penalty. So you just want to make sure that if there is a prepayment penalty, look at the total cost, how much is it, what is the rate, and do the math, put the pencil to the paper and weigh out everything to make sure it's a win-win for you and the seller, and most importantly, your family. So back to the attorney. The servicer, the attorney is going to service the loan, and what happens is you simply pay that attorney on a monthly basis, or they can do direct draft. If they pull your money, they're going to hold your money, and they're also going to figure out what are the taxes, what are the insurance on a monthly basis so they can pay it. That way, when that comes due every year, your taxes and insurance, the funds are there to actually pay it. That way you don't have to come up with it in one lump sum. Things kind of get behind the 8 ball. Next thing you know, your Christmas and set in and birthdays, and so it's much easier to just have it in one payment. They escrow that a payment. Makes it super simple, super easy. Now, the only negative to that is they may charge you $30 to $35 on a monthly basis to do that, but it just simplifies everything. It makes it super easy, so you pay one person, not just the seller, and most importantly, you make sure the seller's getting their money. And in some states like Louisiana, they have this process, it's called bond for deed, where the home actually does not have to be paid for. This home, there's still a balance on this home. The seller is selling this home through the process of called a bond for deed. And it's quite simply a matter of you take ownership, they want 10% down, $35,000. They'll finance this house over 30 years. Your payment would be literally less than $2,800 a month on a home like this, for an example. And there's a 3 to 5 year call on it. Once again, everything is negotiable. Now, once you can nail down an agreed upon price between you and the seller, you're also going to negotiate the terms. You just want to simply ask them, how long are you willing to finance the property? Would you do it for 15, 20, 30 years? And you can calculate and figure out what your mortgage payment is going to be simply by Googling mortgage payment calculator. It's that simple. But you also have to remember, you have to add a rate to that. So there's going to be an interest rate. Not always. I've met several buyers over the years that have called me to sell their homes, and they say, Wayne, we've been paying owner's terms. It's like, what's your payment? Here's our payment. Here's what we bought it for. What's your interest rate? We didn't have an interest rate. So it really just depends. The bottom line is, if the seller doesn't put it in there, that doesn't necessarily mean you have to pay it. You're still paying them, but here's what's really important, and here's where you can really get burned. You got to make sure that when you're paying an owner for that home, there is an amortization schedule, and that amortization schedule is going to show you how much is going towards the balance that you're paying that seller and how much is going towards interest. And what you don't want to do is not have an interest rate and you think, I don't have to pay them any interest rate at all. Well, you put money down on a piece of home, a property, but every cent that you've been paying that owner has been going straight to them. The last thing you want to do is buy a home and pay 100% interest. That's no different than renting. That's what I tell people. It's always best to own a home. If you're watching this video, you want to be a homeowner. Most people do. And I always suggest and tell people, you have to understand that if you rent, you're paying 100%. A lot of people, they go, wow, I never thought about that. Yeah, you have to have food, shelter, clothing, transportation. I get it. But you have to understand that if you're paying on a car, you're not leasing it, after it's paid for, it's yours. But you don't do that when you rent. So it's just always important to know that when you rent, you pay 100%. Now, when somebody tells you, yes, you got a winner, but you just have to simply ask this, what do they need out of the property? Do they have a price that they need to sell the house for? They feel like it's fair. That's always a good way to word it. What do you feel is fair for the property? Oftentimes they'll throw you a figure, but you have no idea the value of the home. Now, there's a couple of ways to determine that. You simply can have it appraised, that'll cost you $400. You can have an appraiser pull comps for you, but not a full appraisal. They still may charge you a couple $100. You can have a real estate agent look at it and you just tell them, hey, I'm looking to buy the house straight from the owner. What would you charge me just to pull comparable properties? Another way is to simply ask the seller, hey, have you had a recent appraisal on the property? And if so, if it's done within the last 6 to 9 months, then it's pretty fair market value if you can buy it for that appraised value, because that appraiser is going to pull comparable properties within the last 6 months of the sales of neighboring homes compared to that home that you're looking to buy within a 3-mile radius. Now, appraisals, real estate agents, another way is to go to your county seat, your county clerk of courts, and they'll have the tax records there, and you can look at what the property's valued at based on taxes. But here's the thing, you just have to know, the tax value is often different. Sometimes it can be more, sometimes it can be less, so you don't just want to rely on that. Another way is to look at Zillow. Now Zillow, they give you these estimates, but you just have to understand you're relying on computer, software, website, if you will, based on some past sales, not all past sales, to tell you and determine what the value of the home is. At the end of the day, the best way to determine if that home is fair market value, pay $400, have it appraised. Now there's a multitude of things that you can do, and a few of those are check the flood zone. Is the property in a flood zone? And if so, what is the flood insurance? How often is it flooded? I always tell people, get out and talk to the neighbors when in doubt. Never take just one person's word for it. Walk across the street next door, ask those people, has it ever flooded? How long have you lived here? Would you move back in the neighborhood? You can also pull crime reports, you can pull sexual offenders lists, you can do all that stuff during your what's called due diligence period. And listen, you just want to tell a seller, hey, if you don't mind, I'd like to have 10, 12, 14 days to do my due diligence, just to kind of do a little bit of research. I love your house, I want to buy it, but I want to make sure it's the best thing for me and my family. Not just flood, but you also want to get a copy of the survey. Ask them if they have a copy of the recent survey. Oftentimes homeowners don't have that in their possession, but you can get that at the Register of Deeds office in your county or parish. You can just simply go there, tell them the property address, they'll pull it for you on the map, and for a quarter, they'll give you a copy of that. Once you have a copy of the survey, you can see where the meets and bounds are. You can see the property line starts here and it ends there. That way you can walk the whole entire property. Oftentimes it may not be in a neighborhood, or if it's in a neighborhood, it's on a bigger lot. The purpose in doing that is so you can walk the land and know what land is going to be yours, and most importantly, is anybody encroaching upon your property. That means that somebody have a fence, a shed, a storage building, a doghouse, or whatever it may be, cattle. I've seen it all. You want to make sure that no one is encroached upon that property that you're about to take ownership of. And if they are, you can address it with a seller, so the seller can address upon the person that's encroaching upon the property, so you don't have to deal with it after you buy the home. So look, buying a home doesn't have to be stressful. It should be fun. It should be exciting. That's why I tell people, take your time. Don't get in the rush. Make sure you're doing the right thing. And just know that it is a minimum of a 4 or 5 year commitment, because once you buy that home, you're going to be paying down your principal interest. It's going to be increasing in value. So listen, I hope you enjoyed this video. My name is Wayne Turner. Give me a thumbs up. Leave us a comment. Ask us questions. Subscribe to the channel. And share this video with anyone that you think it may be valuable. Until next time, thank you and God bless.